Hey Steve, Guy Porter here. Just sending you a couple charts as well as this, or the link to this video. Want to talk to you a little bit about what I see as a possible way to take advantage of what's happening in the market presently. You've seen a few PDFs that have some graphs on them, and what's unique about the PDF is that all the graphs seem to look alike. Any hope we had of diversification has been erased temporarily by the liquidity crisis, and it just goes to show you that when there's no money in the market, it's hard to have anyone trade for any appreciable amount of money the underlying stocks. So what I have here is a graph of one of the actively managed mutual funds, and this is a weekly graph. Every bar in it represents 1 week of price action. What's important here, though, is the indicator that I've developed above it, and this indicator I call the 13-day volatility. It's really a 13-period indicator, and let me tell you how I created it. This is computer language for, let's take the highest high of the last 13 days. Let's subtract the lowest low from the last 13 days. This gives us a range of what this fund or stock is trading at, and let's divide it by the close to get some kind of a percentage here. So what the number comes down to is a fraction that tells us in the last 13 periods, whether that's 2.5 weeks or a little more than a quarter, if you're using days or weeks respectively. This tells us how much movement the stock is, or the fund is getting in terms of price over that period. This is one attempt to define volatility, which is kind of a slippery concept in finance. But here's the exciting thing. It's very much agreed that it's hard, if not impossible, to predict price movement in an equity. However, there's a lot of data that says you can predict changes in volatility, and that the changes in volatility that you predict are actually persistent. More volatility, or an increase in volatility, is often followed by more of an increase in volatility. And if you look at the chart here, this is exactly what's happened. I've used another indicator which measures the slope of the first one. Basically, it takes the volatility from 4 periods ago and compares it to a 5-day moving average of that volatility. And I've been doing some work to find out what happens when this crosses the zero line. Essentially, what it refers to is a change in slope. Let me make this a little more clear. As this passes through the zero line, it refers to a change in slope of the volatility as I've defined it. At any rate, volatility is considered by some to be an asset class, which is inversely correlated with the underlying equity, meaning that as the equity decreases in price, volatility gets higher. And if there was some way to take advantage of that, you could make an overall portfolio safer and possibly eke out some alpha. What I'm proposing is this, that we take a look at how we could use the increased volatility that we're experiencing to justify a faster level of rebalancing among these various actively managed funds. And I just want to be clear that we are on the same page about this volatility before I go farther and explain the proposal I have to really take advantage of this in terms of how we're going to allocate our money between these funds. So if you take a look at this, take a look at the PDFs, give me a call, and looking forward to talk to you.